CFO technology investment strategy is the systematic approach through which chief financial officers evaluate, prioritize, govern, and optimize technology investments to support business strategy, digital transformation, operational excellence, and long-term enterprise value creation. As technology has become a primary driver of competitiveness and innovation, CFOs have evolved beyond their traditional role of financial stewardship to become strategic leaders responsible for ensuring that technology investments generate measurable business outcomes while maintaining financial discipline and governance. Leading executive CFO programs emphasize that successful CFOs must combine financial expertise with digital literacy, strategic thinking, risk management, and enterprise leadership to guide organizations through increasingly complex technology investment decisions. In today's rapidly evolving digital economy, organizations invest heavily in artificial intelligence, AI, cloud computing, enterprise resource planning, ERP, advanced analytics, cybersecurity, robotic process automation, RPA, blockchain, digital platforms, Internet of Things, IoT, and customer experience technologies. While these investments offer significant opportunities for innovation and productivity, they also involve substantial financial commitments, implementation risks, organizational change, and long-term strategic implications. CFOs therefore play a central role in ensuring that technology investments align with corporate objectives and deliver sustainable returns. The primary objective of a CFO technology investment strategy is to maximize business value rather than simply minimize technology costs. Traditional investment decisions often focused primarily on acquisition expenses and short-term financial returns. Modern CFOs adopt a broader perspective that evaluates strategic impact, operational efficiency, customer value, innovation capability, digital competitiveness, organizational resilience, and long-term shareholder value alongside traditional financial metrics. Strategic alignment is the foundation of effective technology investment management. Every technology initiative should directly support organizational strategy, whether through revenue growth, cost optimization, digital transformation, customer experience improvement, sustainability, operational resilience, or innovation. CFOs work closely with chief executive officers, CEOs, chief information officers, CIOs, chief digital officers, CDOs, and business leaders to ensure technology investments reinforce strategic priorities rather than creating isolated technology projects with limited business value. Capital allocation represents one of the CFO's most important responsibilities in technology strategy. Organizations face competing demands for investment across digital transformation, mergers and acquisitions, sustainability initiatives, manufacturing capacity, talent development, cybersecurity, and market expansion. CFOs utilize financial evaluation techniques such as net present value, NPV, internal rate of return, IRR, return on invested capital, ROIC, total cost of ownership, TCO, and risk-adjusted valuation models to prioritize technology investments that generate superior long-term returns while supporting enterprise strategy. Cloud computing has fundamentally reshaped technology investment strategies. Rather than purchasing and maintaining large-scale on-premise infrastructure, organizations increasingly adopt cloud-based subscription models that improve scalability, flexibility, cybersecurity, and operational efficiency. CFOs evaluate cloud migration through financial modeling that considers infrastructure costs, operational savings, business continuity, cybersecurity improvements, implementation risks, and long-term digital capabilities while balancing operating and capital expenditure considerations. Artificial intelligence has become one of the most significant technology investment priorities for finance leaders. AI enables automation, predictive analytics, intelligent forecasting, fraud detection, customer analytics, and executive decision support while creating new opportunities for innovation and competitive differentiation. CFOs evaluate AI investments not only through productivity gains but also through strategic impact, workforce transformation, governance requirements, ethical considerations, model transparency, and long-term organizational capability development. Technology investment strategies increasingly emphasize enterprise platform integration rather than isolated applications. Modern digital enterprises require interconnected ecosystems linking ERP systems, customer relationship management, CRM, supply chain platforms, treasury management, procurement, human resources, sustainability reporting, and advanced analytics. CFOs prioritize integrated digital architectures that improve enterprise data quality, reduce operational complexity, strengthen governance, and enable real-time decision-making across business functions. Enterprise data has become a strategic asset supporting technology investment decisions. CFOs increasingly evaluate technology initiatives based on their ability to improve data governance, master data management, predictive analytics, artificial intelligence readiness, and enterprise performance management capabilities. Investments that strengthen organizational data infrastructure often generate long-term strategic benefits that extend beyond immediate operational efficiencies by improving executive decision quality and organizational agility.
Technology investments inherently involve significant risks, requiring structured governance. Implementation failures, cybersecurity threats, vendor dependency, integration complexity, regulatory changes, organizational resistance, and evolving technology standards may reduce expected investment returns. CFOs incorporate enterprise risk management into investment evaluation through scenario analysis, stress testing, sensitivity analysis, milestone governance, portfolio management, and post-implementation performance reviews that strengthen investment discipline and organizational resilience. Technology portfolio management has become an important responsibility for CFOs overseeing multiple concurrent digital initiatives. Organizations increasingly evaluate technology investments collectively rather than individually by balancing innovation projects with infrastructure modernization, cybersecurity improvements, regulatory compliance, and operational efficiency programs. Portfolio governance optimizes enterprise resource allocation while ensuring investments remain aligned with strategic priorities and organizational capacity. Successful technology investment extends beyond financial analysis to include organizational transformation and change management. Technology adoption requires redesigned business processes, workforce capability development, leadership commitment, governance frameworks, and cultural adaptation. CFOs support transformation by funding training programs, measuring business benefits, monitoring adoption rates, and ensuring technology investments generate operational improvements rather than simply replacing existing systems with new platforms. Environmental, social, and governance (ESG) priorities increasingly influence technology investment strategies. Digital technologies support climate reporting, carbon management, sustainable supply chains, resource optimization, diversity analytics, stakeholder reporting, and responsible governance. CFOs evaluate sustainability-related technology investments by considering regulatory requirements, investor expectations, operational efficiency improvements, and long-term enterprise value creation alongside financial returns. Performance measurement remains essential throughout the technology investment lifecycle. CFOs establish key performance indicators, KPIs, covering return on investment, productivity improvements, automation rates, forecast accuracy, customer experience, cybersecurity resilience, digital adoption, process efficiency, and strategic impact. Continuous monitoring enables organizations to evaluate technology benefits, identify implementation challenges, optimize investment portfolios, and strengthen governance over future digital initiatives. The Global Competency Framework identifies digital capability, strategic thinking, business partnering, leadership, governance, enterprise risk management, data analytics, performance management, corporate finance, and organizational transformation as essential competencies for executive finance professionals. Modern CFOs are expected to lead technology investment strategies that integrate financial stewardship, digital innovation, governance excellence, and strategic leadership to accelerate organizational transformation and sustainable value creation. In today's technology-driven global economy, CFO technology investment strategy has become a defining element of executive leadership. Organizations whose CFOs successfully align digital investments with corporate strategy, financial discipline, AI adoption, cloud transformation, enterprise data governance, and organizational capability development are better positioned to accelerate innovation, strengthen competitiveness, improve resilience, optimize capital allocation, and achieve sustainable long-term enterprise value through intelligent technology leadership.